here. Grace, welcome. Jake, welcome. Appreciate you all coming.
Good to be here.
Good to have you, Jake. Well, very good. Let's go ahead and continue this presentation. Now, before we get into the meat of our discussion, I always think it's important to understand who's giving the information. Um, so I'll go over a couple of my qualifications. I got into real estate about 9 years ago, straight out of college. Funny enough, Jake here that just joined is the guy that introduced me to uh, my mentor and got me into this business. So, Jake, I appreciate your role in my life. We got out of it right out of the gate, just buying and selling land. It was all focused towards multifamily. But I bought a lot of properties and sold a lot of properties to builders for them to finish out construction. Eventually, after doing a number of those deals, started building myself and getting that experience. Overall, over the last 9 years, I've experienced a lot of ups and a lot of downs. And some of that's market based. Some of it is just, the lessons that you learn in any business as you test things out. I've had deals where we've made, millions in what seemed like very little effort, and I've had deals where I've put in a lot of effort and worked as hard as I could and broke even. And in some cases, lost some money. Fortunately, I haven't had a position where I've lost money for an investor yet. That's been my own uh, experiences and trying to de-risk deals before we bring out investors. But I've got a lot of lessons that I can share and hopefully can benefit those that are participating in this call and future calls with us. So the topic of today is multifamily investment, and why is this a good asset class to invest in? Now, if you don't know, me and my company, Surge Investment Group, we like new construction. So you could buy an apartment building that's already existing. Sometimes that's newer, sometimes it's older. And there's some great benefits in doing so. Some of them highlighted here in this slide. But we tend to buy land and build a new apartment complex and start from scratch. And there's a lot of benefits in doing so too. A little bit different risk profile. Sometimes there's different benefits with one over the other. But for this conversation, I'm going to be focusing on new construction, what we specialize in. Now, I don't know if you guys have heard. If you haven't, then I don't know where you've been, but a hot topic in the country right now is the housing affordability crisis and really affordability as a whole. It's becoming very expensive. Funny enough, I'm not much of a cook, but I a couple weeks ago I went and learned how to make chicken tikka masala because I'm like, I can't continue to go to the restaurant and pay for this. It's just getting too expensive. So everybody's feeling it. Now, here's a couple numbers I want to share with you regarding housing affordability. Right now in the US, the average home buyer needs $110,000 annual salary in order to afford a home at the median home price, while the average household income for the United States is $83,730. So there's about just a little bit over a $25,000 discrepancy between the income that you need to be able to afford a median priced house versus where the income's at. That's a pretty big gap. Now, as of right now, approximately 57% of US households can't afford a $300,000 home. This is a significant issue, as home ownership has always been the American dream, and it's something that a lot of people my age, I'm in my early 30s, talk with people in their late 20s and into their 30s, have a difficult time being able to afford a home for them and their families. Now, why is this important for us? This is a sad story for America, and for those that are living in it, but it's a positive for investors because there's always money to be made where there's an opportunity. And those that can't afford to buy end up becoming renters. So this is one of the primary reasons why to invest in multifamily and why multifamily has been such a strong asset historically over the past 20, 25 years is because there's an increasing demand for rental units, especially those that are nicer and catered towards your that gap between the $83,000 salary and the $110,000. Most of the people, when we build an apartment complex that we're renting to, make salaries between $60,000 and $100,000 a year. So there's a lot of those that need housing in that category. There's not enough housing for them right now. It's estimated in the US that we're short on inventory about 2 to 3 million units. And so while there's been a little bit of a dip in the multifamily asset class over the last 2 years, given interest rates and how the market's performed, it's still been able to keep the fundamentals, and we're starting to see performance increase over the last quarter of 2025, and I anticipate that'll continue here in 2026 because of that demand. Now, when you start investing in real estate, most people begin by buying a single family home. Maybe you lived in it, maybe you bought it as an investment, you lived in it, moved out, and decided to keep it as a rental. But that's the starter investment. So as you buy those types of assets, a lot of people will buy another home and another home and another home, which is a great way to accumulate wealth. But as you scale, as you buy more homes, it becomes a lot harder to manage. So one of the key benefits to multifamily is it's all under one roof, right? If you have an issue like a damaged roof, you don't have to replace 10 roofs at a time. It's all under one with those 10 units. Another issue here is management cost. As you uh, have other people manage the property for you, especially if you have multiple homes, it becomes necessary for you to have someone help you. Most management companies that are managing single family portfolios are going to be charging anywhere from 8% at the very lowest up to 12, 14% of your rents collected as their fee. Well, as you graduate into more density, your multifamily communities, depending on the size, uh, your property manager will be charging anywhere from 3.5%. I even have a couple complexes that are lower than that, up to 6, 7%. So you're saving a lot on that upfront management fee, which adds up, and your expense ratio tends to be a little bit lower. Obviously, passive income is a significant benefit towards investing in multifamily. That's why most people get into it, is to receive cash without having to work each day for it. A little bit lesser known perks include hedge against inflation and tax benefits. So we'll talk about both of these. Now, historically, multifamily, amongst other asset classes in real estate, fare very well against inflation. Um, and the year-over-year appreciation tends to be very strong. From a tax benefit standpoint, this is the primary reason why the wealthy invest in real estate. And there's some really cool things that you can do here with tax benefits that oftentimes can come close to equaling the cash flow that you might receive on a property, if not exceeding that cash flow. So we'll talk about a couple of these details here. Let's assume a couple things. So let's say you have a business or you have an occupation that's earning a high income, maybe 500,000, 600,000 plus a year. In that case, most of those people are going to benefit greatly from investing in a multifamily apartment complex. And there's a thing called accelerated depreciation. So that allows you to take losses on the multifamily building or real estate that you own, which shelters you from having to pay taxes. So in an example here, say you're a doctor and you're making $600,000 a year. Normally, depending on how you manage your taxes, you're going to be paying between 20 and 30% of that $600,000 in taxes. So approximately, let's say $180,000 is what your tax bill that year would be owed. Well, in this scenario, let's assume that you for that year invested $1 million into an apartment community. That $1 million is then going to go to work for you by receiving income. But the tax benefit here is you get something that's called a cost segregation study. So a cost segregation study is uh, a study where you hire a professional to go to the property and they do an analysis of your building. Now, the useful life from a tax standpoint for a building is typically about 40 years. And sometimes that might be different, but let's just say in this example, it's 40 years. That means that you're able to depreciate your building, the value of your building over a 40-year clock. Well, there are a number of items in that building that expire much faster. So, for example, you might have your AC units or your appliances or your carpet or your lighting fixtures. All these things you're going to have to replace well before that building itself expires. And so the cost seg study identifies all those items that are going to expire much faster and that you'll have to replace through the useful life of that building. And it allows you to write those off on an accelerated schedule. Now, with the big, beautiful bill that was passed, I think back in June or July of this year, most of those effects are going to come into place here in 2026. It reinstated something called 100% bonus depreciation. So that's an added benefit that we haven't had over the past few years. So basically, with that $1 million invested in this example into a multifamily apartment complex, you do the cost seg study, you take advantage of the 100% bonus depreciation, and you can write off now the entire cost of the accelerated items over the first year because of that bill. So that looks like for your $1 million investment, you're getting anywhere from a $300,000 to $350,000 loss that you can then write off in the first year of ownership of that building, which if your tax bill originally was $180,000, you're completely eliminating the taxes that you had to pay on your ordinary income. So that's one example of how taxes can how you can benefit by saving taxes here with multifamily ownership. All right, let's talk about the deal life cycle. What does a deal look like from start to finish? How long does this take? What are the steps, etc. Now, before I get into this slide, I know we have a few other people that have joined us on LinkedIn Live. Welcome. We appreciate you coming and listening. If you'd like to participate in our Q&A at the end, you'll want to join us via Zoom. There's about a 60-second delay between me speaking and when you're going to hear it on LinkedIn Live. If you join Zoom, there'll be no delay. So that'll allow you to ask questions at the end. If you just want to participate by listening to the presentation, then staying on LinkedIn Live is great. Either way, we welcome you here. So what does a deal look like start to finish? First, obviously, it starts with deal sourcing. So this is finding the right property. Now, depending on what your preferences are, you might have different criteria. For example, I like to find properties that are on highways or big commercial corridors, so there's a lot of traffic passing by. I also like to find properties in secondary markets. So a great example of the relationship between a secondary versus a primary market would be in Texas, you have Dallas, Fort Worth would be a primary market, or Austin, Texas would be a primary market. Secondary markets might be College Station or Waco. So these are still large population areas of about 150,000 plus. So they're not small towns, but they're not the large cities that you have with 1 million plus. Now, I like to find those types of cities because I find there's less competition and a lot of unmet demand. But there are many companies that only invest in primary markets. So you got to know what your criteria is, what you're looking for, what type of risks you're willing to take. For example, if you want to go to a small town that's 15 to 20,000 people in it, there's not a lot of surrounding there, then you're taking a risk to see if you can fill up that complex. So that all just depends on what you're looking for. Once you find your property, then it goes into entitlement and permitting. So entitlement, for those not familiar with this business, is a unique term. What that means essentially is it's the process of taking just a piece of land, a piece of dirt that you drive by every day, into conceptually what can become a project. So that you're hiring your engineer, you're hiring your architect, all these reports and studies you have to do to make sure the property is buildable. They design conceptually this project, and then you have to go and get something approved with the city. You can't just build something because you want to build it. Now, sometimes you might have a property where you have to change the zoning. So the city has designated areas where they allow certain uses. And maybe your property fits the use that you want to do. Maybe it doesn't. And in order to do what you want to do, you might have to change the zoning. There can be some risk associated with that. But if you're successful in doing so, it can also be significant in creating value for your property. Now, if zoning is a rezone is not required, you still have to go and get your plans, engineering, architecture all approved through the city. Anyway, that's all called the entitlement process. Now, let's say you found your property, you've taken it through that entitlement process, you have an approved project, you have your permits, now you can build it. Well, then you have to figure out how you're going to fund it. Funding consists of two components. There's debt and there is equity. Equity, think of this as if you're buying, because many here have gone through the process of buying a home for them to live in. When you buy a home, you usually have your down payment, and then you have the bank loan that comes in and finishes the rest of your purchase for the property. Your equity is the equivalent of your down payment. So that's how much money you are bringing, you or your investors are bringing in cash. And then the debt, that's a loan that you're going to get for the remainder of the property. Now, leverage is a key component to building anything really, as far as what you're willing to risk. The less equity that you bring in and the more leverage or debt that you bring in, the riskier it is if you build it and the market is poor. Now, if you have a lot of equity and very little debt, then usually there's going to be very few risks associated with building your given project. The next, after you get this funded, is going to be development and construction. Development is often a term that describes the horizontal construction that's pushing dirt. That's where you see the tractors moving stuff. Construction is going to be when you actually start framing and building upwards. And then once you have a completed project, you have your lease up. So now it's all completed. People are ready to move in. You have to hire a team to get people to fill up these units as quick as possible. So that's called the lease up period. And once you have a full building with tenants and you're receiving income, that's called stabilization. And you go to the long-term operations of that property. So that's the deal life cycle. Depending on the deal, depending on the location and the city that you're in, because each city has different timelines and ways of working through things, this process could take anywhere from 2 years all the way to 5 years before you get this last piece, which is stabilization. Okay, so now you know the process. Let's talk about where value is created in this process. This really is going to happen every step of the way. Now, some of these processes take, or some of these steps allow for greater opportunity of value creation. What you always want to do, and this is the reason why we do new construction as opposed to just buying something that's already built, is forced appreciation. The more appreciation that you can force or value that you can create in the process of construction, the more opportunity you have for earnings later in the process. So we like to start this off with land basis. So you're going to have land basis, entitlement, and zoning. If you can buy a property well, there's a lot of value you can create here. Let's use an example. So let's say I want to build 140 units, 140 apartments on a piece of property. I want to go find a property where I can do that. Well, if I find a piece of land, typically in Texas, let's use Texas as an example, running with our previous uh, primary and secondary market example. A piece of land is going to be worth raw, meaning there's no entitlements, no permits done, no plans drawn up. That's going to be worth about 7,500 all the way up to potentially $14,000 per unit, right? So that same property, after you take it through an entitlement and zoning process, there's value that's created there. Well, now that property that was worth 7,500 to 14,000 per unit, because it has all of the permitting done, you know exactly what you can do there. That same property is now worth anywhere from 14,000 and depending on the market, could be all the way up to $30,000 per unit. So just in the entitlement process alone and buying the land at the right price, you've created, $1.5 to $2 million in equity on just the land purchase. Now, some companies out there prefer and aren't very good at finding land, and they'll just go find stuff that's listed on the market already. And if it's listed on the market with an agent that knows what they're doing, they're just going to be charging you $14,000 to $30,000 per unit already for that property. And so they're not taking advantage of this equity or value creation in that process. We like to do this. We're very good at finding land. It's one of our strengths. And so that's a benefit that we receive in doing so. Now, cost and design. Let's talk about that. There's going to be a couple important factors here. Again, I can't go through all of the details on this just because this could be its own presentation for 30 to 40 minutes. But this is one of the key areas where people miss. Oftentimes, multifamily investors will invest with a friend or family member who does this, and they aren't familiar with how to navigate the contracts and cost control. A couple examples of what we do with this are first off, repeating design. So in the process of construction, there's always going to be issues. There's always going to be waste that comes up. But oftentimes you fix those issues as you go along in construction. So uh, if you take, let's just say I built a 36 unit building uh, on a property. I've built that. It's now completed. Now I know every issue that came up in the process of building that 36 unit building, communicated that to the engineers and the architects. So now we have notes on the fixes that we had. Well, now we can take that same 36 unit building, and if we build that same building on a different site on our next project, we already know all the issues and we've found solutions, and we can design that into the plans on that next building, and that helps us to eliminate the time delays that we have, but also the excess materials or change orders that we had come up through that process. And a change order is basically a contractor coming to you and saying, well, we agreed at this price, but now we have to increase the price because we didn't plan accordingly. Now, some other things that you can do in this, and this is going into operations and execution, is it's very important to understand the contracts that you're entering into, and you're negotiating those contracts up front. It's so much easier to keep change orders from happening if you have language in the contract that clearly identifies the circumstances where the contractor is allowed to bring those to you. And I'll talk about this on the next slide, but we go enter into what's called a GMAX contract, which means it's a guaranteed price. And so the only time that a contractor can come to you and change the price is if there's something that they have to do on the property that you didn't already have in your plans. In addition, with operations and execution, time is key. Now, if you have 6 months in construction delays, maybe the construction crew didn't hit you with change orders, so the price is the same, but that's another 6 months that you had to pay interest on your construction loan that you wouldn't have had to had you been on schedule. So it is important to stay on schedule and manage the contractor and the process efficiently and effectively. Now, moving on to these last two, capital structure is another key element here. Sometimes it's easier to get a loan done that's a little bit more expensive. I do that often, where you're dealing with a private debt fund or other sources of capital, but they tend to be more expensive. So they might be charging 10% interest, whereas a bank might only be charging, 5.5 to 6%. And so there, if you're able to qualify for cheaper bank debt, you're willing to do recourse, meaning you're willing to let the bank come after you personally if the loan gets foreclosed on. You can save a lot of money there and create more equity for yourself. And lastly, time and market conditions. That's one of those things that is oftentimes out of your control. But if you're able to manage all these other things effectively, then you're usually in a position where you can wait out the market for a favorable time to exit. And when you are able to align all of these things, let's say you're in a great time to sell, you're able to manage this effectively. You're walking into a great land basis. You finish on time at favorable financing. I've seen deals where investors have been able to yield anywhere from 30 all the way up to 70+% annualized returns on the projects. Now, that's not a guarantee every time you invest in multifamily, but market timing, if that's on your side and you're doing everything else effectively, you can get some very, very strong investment returns in this asset class. Now, let's talk about some of the risks because multifamily is considered a high risk investment, and for good reason. But there are many things that you can do to mitigate those risks. Fortunately, many other high risk investments are hard to mitigate risk. You can plan and try your best, but multifamily and real estate in general is one of those asset classes where you can get the high reward of investing in this while eliminating a lot of the risks that oftentimes will present themselves. So we talked about some of these here in the last slide. Cost control is a big one. And like I said, what we do is we do GMAX contracts, which means it's a guaranteed maximum number. Let's say you enter into a contract to build a property for $20 million. Well, the only time the contractor is now committed to building that for $20 million, and they'll build in a profit for themselves. But let's just say material costs increase during that time. Well, then the contractor has to eat that in the profit margin that they had. They can't pass that on to us. The only time where they can come in and claim more money than that $20 million would be if there was something that we asked them to do that wasn't included in our original contract. Or maybe something was in the plans. It wasn't included in the plans, but we found out later that they had to do it anyway. And so the way we do this is we do GMAX contracts. We get really detailed in the contract negotiation, make sure the language is there to protect us against anything that they might try and come back and hit us with. We make sure that our plans are complete. We have third parties review them. And again, we repeat the same buildings that we do and unit plans that we do every single time, so that we really only have to go through the learning process on the first project, but then the next one we now have, when it comes from building upwards on that building, we know what those issues are going to be. And lastly, you include contingency reserves, so that there's always going to be something that you can't foresee for. You have a budget there to cover that, and it's not eating into your projected returns. Timeline management is another thing that's important. Again, the more the project's delayed, the more interest carry that you have to pay. Oftentimes, what you can do to mitigate this, you schedule buffers. So sometimes when you're in a place that has weather, such as Florida or much of the Southeast, you know that there's going to be rain delays and weather delays. So you schedule time up front for those things. We like to create contractor alignment. So oftentimes the projects that I build, my general contractor is a partner, an owner, investor in those projects. That makes them aligned of wanting to perform well for us. We include in the contract negotiation milestone-driven incentives. So if they deliver early, they get extra money. If they deliver late, they have to pay fines or fees. And then early purchases of materials. Timelines can be impacted significantly. We saw this in COVID, where there were certain materials that were just way behind. There were lead times of upwards of 12 to 18 months on certain materials, and it became an important factor in being able to get projects done on time. So if you know that there's going to be significant lead time items, buying those materials early and ordering them up front becomes very important to keep the project on schedule. So and team selection and coordination, there's really on this one, the most important thing is alignment. So you want to have people that are invested in the project, invested in you, and delivering well for you. And experience. Experience is critical in selecting your team. Is this someone that's done this before? Oftentimes you can get a better price by someone that doesn't have as much experience, and sometimes that can be worth it, but oftentimes you end up paying for that lack of experience in the end. And that can come with general contractors, architects, engineers. All those groups can make costly mistakes, and at the end of the day, you end up paying for it. So experience is the most important thing when deciding who you're going to work with, and that mitigates a lot of risk if you just work with someone who's been there and done that. Market timing, again, that's out of your control, but obviously is always a risk. We saw this in 2022 when interest rates started to really skyrocket. That was something that affected the entire market. It slowed down sales, made us have to hold on to our assets, and we're still overcoming a lot of that, although it's getting better. So now on the flip side, if you had built something back in 2016 and sold it in 2020, then that was a great time to be in the business. And that's where you saw investors making returns like 30, 40, even 50% annualized on their investments. Then the last thing I want to talk about here, and perhaps the most important development or risk mitigation strategy, is leverage. So leverage is the amount of equity versus debt that you bring to a property. Now, why is this the most important thing? Well, really, other than being able to finish a project, which if you're working with someone who is qualified and you have a contract with them, you're going to be able to finish a project, assuming you have funding as well, of course. But other than that, the primary risk is, at the end, once you're done with construction, are you able to get a loan to take out the construction loan and avoid being foreclosed on? Well, the leverage here is key because it's going to be a lot easier to get a loan to take out your construction loan if you have a lot more equity in the deal. Most of the time, if you try and do something very, very high leverage, let's just say loan to cost is LTC. So that's the ratio between how much of the loan that you have compared to the overall cost, and then your equity is the difference in there. Now, if you try and do a loan that was at 85% loan to cost, which I saw deals getting done at that leverage in 2020, 2021, because you had banks and lenders that were aggressive wanting to get deals done. Well, you build that project for 2 or 3 years, and now you're in 2022 and 2023, where the market has gotten really conservative. Loans were only getting done at 60 to 70% loan to cost. So now you have a gap there that's 15 to 20% that where you don't have that equity. It was debt. Now I can't get debt to replace it. And so my only option is I have to go raise more money or bring more money. And if you don't have that, you have to sell it for whatever a buyer will take it for. Otherwise, sorry, I have a bottle here I just hit. Otherwise, you risk getting foreclosed on and losing all of your initial investment. Now, in this case, if you're building something with construction and you're bringing 40% or 50% of the capital stack, so you're only getting a loan that's 50 to 60% LTC. Well, if the market now takes a dive during the time that you're under construction, there's still going to be plenty of loan options for you to come in, because even in a bad market, lending on 50% of the value of a property or 60% of the value of the property is a safe bet for lenders. And so that just reduces the risk of future foreclosure if the market doesn't go your way, right? And it also gives you room to eat, you know, some of these other risks that come in. If it takes longer, you have higher interest, but you have equity to be able to absorb that. Same thing if you have some unforeseen costs that come up during construction, you have equity to absorb that. So leverage is always an important element in helping to protect your investment here. All right, so this is our last slide. Then we're going to get to the Q&A. Again, if anyone has joined the LinkedIn Live event and is listening to this via LinkedIn Live, if you want to participate in the Q&A, join the Zoom link that's included in the comment section. It's also in the description of this event. That'll allow you to interact with us back and forth. Now, how do investors consider risk and return? So we talked about the risks. We've talked about some of the benefits. Here's a ratio now of, well, how much risk am I willing to take for the potential return? Now, again, this is one of the reasons why I like to focus on new construction as opposed to just buying an existing building and getting cash flow. There's this ratio between cash flow and potential upside. If you buy an existing building, you're going to get cash flow from day one, but oftentimes it's a little bit less because you're having to buy it for the value of a finished product. And your appreciation over time isn't going to be as significant. Whereas in construction, you kind of get the best of both worlds. During that 2 to 3 year construction period, you force a lot of appreciation. And so you're sitting on a lot of created equity there, but you have to wait 2 to 3 years to rent out your building and start receiving cash flow for that investment. So it really is, what is your preferences? What are your goals for an investment? That'll allow you to determine, how much risk you're willing to take to be able to achieve those goals. From a time horizon standpoint, the shorter term investments tend to be riskier over longer term investments. If you say, I want to build and sell something and do it in 2 to 3 years, well, then you're going to be highly dependent on the timing of the market and where investors are willing to buy that finished building whenever you deliver it. But if you say I have a 10-year investment horizon where I'm going to build this and I could sell it in 3 years, but I'm also willing to hold it for 10 years, well, the chances of that 10-year period having a favorable market window that allows you to exit favorably is much, much higher, and it reduces the overall risk of your investment plan. Now, the most important thing, I touched on this previously, the most important thing is, especially when you're investing in someone else, is track record and historical performance. How have you seen them perform in the past? Can they do and will they do what they say they're going to do? That's paramount. And I've met many groups, and this is part of the lessons that I've learned, as mentioned in the first slide. But I've met many groups that can say that they'll do a lot of things. They talk a big talk, but at the end of the day, they can't perform, and in some cases, they're dishonest. And I've had contractors, for example, that have stolen money and walked off a job, and that's part of the risk of this job. But again, you can mitigate a lot of that by working with people who have a long track record and good, solid reputation in the industry. Okay. So I hope that's been somewhat educational for everyone that's participated here. Again, if you're joining LinkedIn Live, join the Zoom link if you want to participate in the Q&A. We've got a few people here on Zoom. Would love to hear any questions. I'm happy to dive into any topic that we reviewed today or something else. I'll invite anyone here on the Zoom to unmute themselves and ask any questions.
Hey Paul, Happy New Year. Thanks for this video. It's been really informative. Just had a question. You mentioned during how sometimes you'll go with a more expensive lender, like a credit fund. and you'll pay a little bit more. I was kind of curious, do those credit funds still require a guarantor, or are those non-recourse, or does it just kind of depend?
Yeah, that's a great question. Thanks, Race. I appreciate it. Um, yes, everyone's different. So some of those groups will still require a guarantor that's full recourse. And again, for those listening that don't know what recourse versus non-recourse means, it's just think of it as if you get a loan, that creditor wants to know if you fail to perform on paying that loan back, how are they gonna recoup their investment? And recourse is a mechanism that allows them to go after personal assets of yours that are pledged uh, with that loan. Whereas a non-recourse loan means that their only recourse is the actual property. So they could go and take over the property, but they can't go after your personal assets that are unrelated to that property. And banks, let's say banks, life insurance companies, other institutional, larger lenders out there, sovereign funds, oftentimes will lend, but they'll do so on a recourse basis, meaning that they'll only do the loan if you pledge your personal assets to the loan as collateral on the loan. And the exchange to doing that is that you get a cheaper loan at better terms. Now, more expensive debt funds and other lenders that are willing to do non-recourse financing, it's a higher risk for them, but it's lower risk for you as the lender. It just takes the asset and they look at that asset and say, is this worth doing the loan against as my only recourse? And if they're willing to do that, then that's a great option to protect you as the builder or investor. Now, non-recourse lenders are a little bit more expensive. That usually they're about 2 to 3, maybe even 4 percentage points greater on the interest rate. But the trade-off there is you get better protections. Um, so to answer your question, some of those private debt funds will want some level of recourse. Most of the time, it's non-recourse, and most of the time they won't require a guarantor as much as they will a completion guarantee. So they want to make sure that the project's going to get done at the very least. But that's different than actually pledging your assets as collateral to the property. Great question. Any other questions, Race, or others that have joined here? Okay.
Yeah, I'll ask one more, Paul.
Yeah.
Are the LTCs on those fairly comparable, like recourse
Yeah.
versus non-recourse? And did you say you're seeing somewhere around like 60 to 70% LTCs these days?
Yeah. Another great question on the lending. The LTC tends to be different. So your private, more expensive debt funds, they'll do non-recourse and they'll usually go a little bit higher in the capital stack. So right now, what I'm seeing, most banks uh, are anywhere from 50% LTC of what they'll offer, all the way up to 80, or sorry, all the way up to 75%. But 75% loan to cost is going to be your most aggressive banks. Now, other non-recourse options that are not quite private, but they're less expensive include HUD financing and other government financing sources. That's really good, especially once you have a built project. It's hard to do construction with Fannie Freddie loans, but once you're built, to take out of the construction loan, you can go into a Freddie or Fannie loan. It's not going to be recourse. It's going to be non-recourse, but you're still going to get some of the best interest rates out there. So that's usually what we plan to do after we've built a project and refinancing into it. Before construction, uh, you do have a HUD construction loan that you can utilize too, which gives you a much lower rate than is in the market. It's non-recourse, it's asset-based, but then you're dealing with extended timelines. It takes about a year to go through the HUD application process to qualify for that financing. But then the benefit is once you build the project, there's no refinance. It just automatically moves into a long-term HUD loan. So that's a benefit as well. And then you have the private debt funds will usually go anywhere from 70. I've seen some more conservative at 65% loan to cost, but most of them are going to fall between 70 and 80% loan to cost uh, as of the market today. And then you have other options that can get you even higher in the capital stack, such as a preferred equity or a mezzanine lender. And preferred equity or mezzanine lenders, they're groups that will come in smaller size loans. Usually you're going to be between 5 and 15 million on their loan amounts, and they're going to be behind a primary lender. So it might be a bank as the primary lender or another debt fund that'll come in and say they're going to do 60% loan to cost, but then the mezzanine loan will come in and fill the other 20 to 25% and get you to 80% or 85% as leverage, where you only have to bring in 15% of the total equity. So that can be really good, and that you don't have to bring a lot of cash, so you can make something happen without having to raise a lot of money. But it can also be dangerous and risky because once that project is built, I now have to find a way to pay off both the primary lender and that second position lender before I can do anything with that property. And if you're in a position where the market, I can't get lenders that'll come in at 85% loan to value, then you're at risk there. Now, the trade-off is during construction, you do create value. And when you're trying to get that refinance, it's now looking at the full built value of the property. So it's not necessarily loan to cost now, it's loan to value. So you get an equity bump there. But if it's in a market where that's been minimized, that equity generation has been minimized, then it can still be hard. And then you're at risk of having to either sell at a low price or risk getting foreclosed on. Does that help answer that question, Race?
Yeah, thanks so much. Honestly, there's a lot of components to this, so I really appreciate the breakdown.
Yeah, it's a and there's a lot more that I haven't said here, but it's a complicated business, especially dealing with lending. I think getting debt is probably the hardest thing that I have to deal with on a day-to-day basis. So glad you asked those questions. Any other final questions? Those that are here. All right. Well, I really appreciate everybody participating in this call. I hope that this has been valuable. Now, this is our first attempt at LinkedIn Live. This is something that I plan on doing each week. Now, some of these calls are going to be formatted a little different. For example, every other week we're going to do a case study where we'll take a project and we'll go through the underwriting of that project and dive into the numbers, what types of details you need to be considering in approaching that underwriting. So that'll be next week, January 13th. We're going to hold that call. The following week, that's going to be January 20th. We're going to talk about 2026 and how the industry in multifamily is looking for 2026. I think there's a lot of exciting things that are coming. It's been a bit of a slow period here in 2024 and 2025, but towards the end of 2025, we've seen a lot more appetite and interest start to emerge for our multifamily assets. I think that's going to continue and really get strong, especially towards the end of 2026. So on the 20th of January, that's where we'll be focusing our time and our discussion. We'd love to see all of you there and participate in those calls as well. But again, I appreciate each of you. A few of you here, it's been a while since I've talked to, but it's good to see you participating. So with that, we will say goodbye and hope to see you all next week.
Thanks, Paul.
Have a good one.
Yep.